Calling all do-it-yourself ETF investors. Do you want to ring the bell at the Toronto Stock Exchange? Join us for ETF Investor Day, our first ever in-person event right here at the TSX on Thursday, February the 8th.
This investor education event will be focused on empowering Canadian ETF investors and providing informative content to help you navigate markets in 2024. There's going to be 3 exciting educational panels, which we've curated specifically for our ETF Market Insights audience. Our insightful guest speakers, who are ETF industry professionals, will provide you with the information and education you need to confidently manage your investment portfolio.
This will be an amazing opportunity to learn from ETF industry specialists and to network with like-minded investors while expanding your investment community. You won't want to miss this event.
Register today at etfmarketinsights.com.
We look forward to seeing you here with us in Toronto.
Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
You're watching ETF Market Insights. Welcome back. Always great to have you join us on this Friday afternoon. We have a great discussion planned today. We have Om Karmakar joining us. Om is an ETF portfolio manager here with us at BMO, and we are going to break down investing in technology and the tech sector for 2024, which has been a really hot topic in 23, and we expect it to be a hot topic in this new year. But before we get started, I do want to remind our audience members, we're not here to provide you any advice. We're not here today to provide you any investing recommendations. If you've been part of this channel and viewed our content before, you know we're very passionate about education. We're very passionate about ETFs, and that's where we keep the conversation. We really just want to empower investors at home to have the information they need at their fingertips to make investment decisions that are right for them. Om, it's so great to have you here with us. I know you do a lot of work at BMO looking at a few different ETF portfolios that hold tech sector type stocks. So I'm really happy to hear what your thoughts are on the tech sector in 2024. So let's start the conversation. Technology companies bounced back. So 2022 was not a great year for tech stocks. And then 2023, we saw a huge rally again. What were the big drivers of growth for the tech sector in 2023?
Yeah, first I just want to say thanks for having me on the show. So you're right. 2023 was a very strong year, great year for technology stocks. So to understand, what caused that strong growth rally, we just need to go back a bit. 2022 was a very tough year for investors across all asset classes, right? It wasn't just equities or fixed incomes. It was across basically every single asset class. It was a tough time, and especially for growth investors. So we did see technology companies take a larger brunt of that hit. And that was mainly driven due to kind of inflation fears in 2022. At that time, inflation was skyrocketing. Feds came out, increasing interest rates at a very fast pace. And usually we see, in a very fast rising yield environment, technology companies tend to underperform or lag the market. That being said, we move into 2023. So at the end of 2022, valuations for these companies were attractive. A lot of these mega cap companies such as Apple, Microsoft were down quite a bit. And that's why their valuations going into 2023 were attractive. Fast forward to 2023, first quarter of 2023, we saw Microsoft invest in the new, that time, people thought it was just a buzzword, but AI, right? Artificial intelligence. So we saw Microsoft invest, I think it was about 10 billion into OpenAI, or which many of us know as ChatGPT. And, that actually began, I would say, the next kind of secular trend within technology companies. And because of that AI investment by Microsoft, a lot of other players started investing in that technology or in that space. So we saw Google come out a few months after, not even a few months, a few weeks after, with their AI called that it was Bard. Then Facebook or Meta came out with theirs. So, we saw huge investments in AI. And, that time, from what helps run AI, you need semiconductors. So that's why we saw semiconductor companies start doing well. So for example, in 2023, if you look at NVIDIA, which is one of the biggest semiconductor companies in the world, it rallied about more than 200%. It was about 230%, right? So that we saw that. And third, I would say, was a lot of these tech companies had a year of efficiency. Mark Zuckerberg, who's the CEO of Meta, at the end of Q4 2022, he came out and said that 2023 will be a year of efficiency. So we saw all these tech companies come out and start doing cost cutting. So, a lot of it was through layoffs. So we saw, a lot of hiring happen pre-COVID or like during COVID years. And we saw a lot of layoffs in 2022 as a lot of these companies started focusing on their main business lines. They started focusing on high margin products or high margin software services to be able to grow their business in a more efficient manner. And because of that, we saw that those companies get rewarded. Biggest example there is Meta. It was marred with expenses. They had, a lot of expenses that they personally, in my opinion, couldn't justify. They started cost cutting. And in 2023, markets rewarded them for that, right? And we saw strong earnings because of that. So those were kind of the three main reasons, I would say, we saw such a big rally in tech stocks in 2023.
Great breakdown of you talked about the fundamentals within these companies that shifted, valuations looking strong after a sell-off in 2022, and then of course that artificial intelligence trade that really was a tailwind for a lot of these companies, especially as you called out the hardware companies, the semiconductors, and then the mega caps as well, really benefiting from that tailwind. So we saw January 2024 a small pullback, perhaps in the tech sector. What are your thoughts here? Do you think artificial intelligence is still going to be a big play, a big kind of trend in investing going forward, or what are your thoughts on the tech sector this year?
Yeah, that's a great question. Always tough to predict how it's going to look in December 2024. But I think looking at what we know as of today, we are constructive on the tech sector, even in 2024, even though it did have a very strong rally in 2023, right? As we know, Nasdaq was up approximately 51% in 2023, but we are still constructive on tech going into 2024. So give you a few reasons why we are constructive. First is the AI, right? It's not a buzzword, right? The way I look at AI is technology, or these companies are entering a new secular cycle. We had a previous cycle, I would say that was more on the hardware side with, the new Apple iPhones, the MacBooks, the iPads that, in the previous decade. But now we're entering a new cycle, or new secular cycle, which is more driven by AI or more software. But to support that software, you need hardware as well, so like semiconductors. So it's not a buzzword. 2023, I would say it was more of an experimentation phase for a lot of these companies, where they were putting money in, researching what's working in the AI space, how they can convert the data they have collected and the applications they have built to real applications that the end user can use. So we will see more of that, where not only will they have impact on, the tech companies, but they'll have impact on different sectors, from music to manufacturing, where a lot of these AI applications can be used. And to power these, AI applications and softwares, you need semiconductors. So we'll still see strong demand for semiconductors. such as Nvidia, we saw AMD, we saw Intel, right? So there's still strong demand for these companies. Second, I think,
Go ahead.
sorry, go
No,
ahead.
you go ahead.
No, I was going to say another thing, that's positive for the sector is, I would say, a more stable economic environment. 2023, yes, Feds were raising rates, until I think it was they stopped raising rates at the end of October. November they didn't raise any rates. So we are entering in an environment or rates environment where it will be more stable or declining. So if you look at kind of what the markets have priced in, they're saying that in the summer, Feds will start cutting rates. And technology companies tend to do well in a more stable or declining rate environment. That wasn't the case in 2023. 2023 rates were still rising. There's still fears of inflation. I'm not saying that inflation fear is gone, but I think markets pricing in a much more stable environment. And just to kind of say why rates matter for technology companies is, a lot of these technology companies have growth priced in for the future. So when you discount those future cash flows back to the present, you discount it at a higher interest rate. So the higher the interest rate, the lower the cash flow amount is. So that's where their valuations get hit. The lower the interest rate, the better for valuations. And finally, last point I would say is, yes, the valuations are not as attractive as they were at the end of 2022, given that strong rally we've seen, but they are not overpriced either. I would say the valuations are reasonable if you look at price to earnings to growth. So that means what the company's PE is versus how much growth they're expecting on their earnings and revenue. It's still reasonable. It's around the 5-year average, slightly above the 5-year average. So you're not overpaying drastically given the huge run some of these companies have had. And one of the main reasons for that is, I'll use Nvidia as an example, where not only did they beat market expectations for their earnings and revenue, they exceeded them significantly for their forecasts. So even though you did have a multiples expansion, it was mainly due to forward earning guidance. So they were earning, or their forward guidance was saying that they'll earn even more than what the market is expecting. So I think those are the main few reasons why we are constructive on technology. Of course, there can be some external macro factors that can always impact valuations in the short term, or can have a negative impact in the short term. Geopolitical tensions across the globe, if inflation starts to print much higher than expected. So there are some, I would say, headwinds, but I think a lot of good tailwinds for the technology sector.
Absolutely. So the kind of that macro headwind of a high rate environment definitely not helping out the tech sector, but of course that secular tailwind of all these trends and artificial intelligence and things like that, seemingly to be more of a long-term growth story more than anything. So, you called out a bunch of different company names at the beginning of the conversation. And for an investor at home thinking about getting exposure to the tech sector, we always say picking a single stock, it's just really, really, really hard. You need a lot of resources. You need to be kind of looking at things every day to try to pick the right stock. And so a lot of investors feel like using an ETF to get access to the tech sector just makes a lot more sense. They get that instant diversification, they get that low cost structure, and it takes like kind of the guesswork out of stock picking. So you mentioned first, let's talk about kind of the passive or the index way to get exposure to the tech sector. You said the Nasdaq earlier on. You mentioned the Nasdaq index, and wow, what a big year it had last year. So how can investors kind of get exposure to the tech sector using an index, and maybe I'll lead you in specifically using the Nasdaq?
Yeah, for sure. That's a great question, and like you said, it is very hard to pick single names and to manage it on a daily basis. So Nasdaq index, it is a passive index. So we do offer ETFs that follow the index, so such as ZNQ, which is the BMO Nasdaq Index ETF, or ZQQ, which is the same index, but it's currency hedged. So for investors who don't want the US dollar exposure, it's a great index because it's a low cost solution for clients who want to get that technology sector exposure, who don't want to go and pick single names, want to have a broad technology sector exposure with some diversification. And what I mean by that is if we do a deep dive into kind of the holdings of the index and look at the sector breakdowns, majority of it is technology, right? I would say about 70 to 80% of the names in there are technology names like Apple, Nvidia, Tesla, Microsoft. But you do get some diversification because there are some non-technology names in healthcare or even consumer staples, so such as Pepsi, right? So I think it's a great tool for investors who are looking for a low-cost solution to get that growth exposure within their portfolio and have some diversification at the same time. And as I mentioned, right, 2023, great year for the Nasdaq, had a strong performance of 51%. So again, I think it's a great way for clients to get exposure without having to do a lot of thinking on which stocks to pick or which how much weight they need in different sectors.
Great. So the NASDAQ just being 100 stocks, many of them, as you mentioned, in the tech sector, but a bit of diversification as well, some consumer names. But let's remember, names like Amazon and Tesla, these are actually not considered tech sector stocks.
Exactly. Yes. Yeah.
They are also consumer stocks. Those are in the NASDAQ. So a little more concentrated, I would say, than other index plays like the S&P 500. So we do see a lot of investors looking to the NASDAQ to tilt their portfolio to that tech sector, that more growthy secular trend within their portfolios. Now, let's take it a step further. For someone who might want a little more of a concentrated portfolio, focused more so on these growth trends, maybe thinking about stepping out of the passive space and looking for something more actively managed, what ETFs are out there that are listed in Canada, that an investor can look at?
Yeah, for sure. So on the active side, one of the best ETFs in terms of performance last year was the ARK ETF. So it's the BMO ARK ETF. The ticker is ARKK. And of course, there's a U.S. version also, as many of us already know. But there is a U.S. version there. But there's also a Canadian listed ARK ETF. It is an actively managed solution, and it is managed by Cathie Wood and her team. And the way the stocks are picked in there are, it's done by very strong research by her and her team. And we did partner with ARK and Cathie Wood back, remind me if I'm correct, but I think it was back in 2022 that we did partner with ARK. And the main reason we wanted to partner with them and, was they have very strong capabilities in being able to find the next innovative stock, right? They have the research capabilities, they have the team surrounding them to be able to find that next innovation stock in terms of the next Tesla or the next Amazon. Just a simple example. In terms of clients, what they will get, if they want that higher growth, they need to understand that it is a bit more higher risk as well. But if the investor is able to take a bit more risk within the portfolio, this is a great solution to have. And there are three reasons why. One is you get really good growth potential. So you are investing for the future because a lot of the companies that are held within ARK are for innovation purposes. So these are companies that are innovating within their space. And that can grow to be, mega tech companies down the road. Second is, it is also a good tool for diversification. And what I mean by that is, yes, a lot of the majority of the companies in there are for, innovative companies. But if you look at kind of the weights of some of these companies, so if you look at Tesla in there, because they do hold Tesla in the ETF, it looks very different from the index. So if you look at the ARK ETF and you compare it, for example, versus the Nasdaq index or ZNQ, it looks very different. And anytime ETF looks different than technology index, it means it can provide diversification to the portfolio. So that's a second way where you not only get that strong growth upside participation, but you will have diversification because the portfolio and the weights within the portfolio are so different than the underlying index. And the third thing I would just say again, I just want to highlight the team, Kathy Wood and her team. They are a great team. They, all their picks for the ETF are grounded in research, right? So it combines not only kind of bottom-up approach of the company, but also top-down approach in its portfolio management to identify, innovative companies and if there are any different convergence across different markets or even sectors. So,
Great. Thanks for that, Om. Did you have anything else or you wanted to add before I jump in?
no, I was just going to say I was just going to give an example of some of the holdings because I know in Nasdaq we already know like they have Amazon. So some of the top holdings within ARK is like Tesla, Zoom, Coinbase, and Coinbase seems more attractive, or it's more in the news now given the approval of some of the Bitcoin ETFs down south of the border. So I just wanted to highlight, they are holding companies that are innovating within its own space.
Yeah, ARC doing a really good job with their research teams trying to find the next big growth trend and trying to find the companies that are most exposed to that trend. So a lot different than something like a passive exposure with the Nasdaq where you have 100 stocks, it's market cap weighted, so you're looking at a lot of, I say FANG stocks, but now it's Magnificent Seven, I think we're calling them, these large cap companies. Something like this actively managed ARC portfolio, you don't see any of the only large cap company in there I think is Tesla. That's secret. That's been a big favorite of Kathy Wood and her team for a long time. But outside of that, a lot of small cap, a lot of mid cap companies, so potential for growth. But of course, we're stepping up the risk spectrum slightly when you look at companies that are mid and small cap, and a more concentrated portfolio as well. So now we're looking at about 40 or 50 stocks versus something like the Nasdaq that's 100 stocks. So thanks for perfect. Thanks for talking us through that, Om. So lastly, for someone who might be an income investor, how can an income investor get exposure to the tech sector? Because I know a lot of income investors are out there and they have a lot of exposure to dividend companies. These are in Canada like telcos, banks, utilities, but these tech stocks, because they're growth focused, a lot of them don't pay dividend or pay a small dividend. So what can an investor do to kind of or an income investor do to fill this gap in their portfolio?
Yeah, no, that's a great question. And, we do see that a lot where, clients or investors who are risk averse or who are entering retirement or are in retirement don't tend to have this growth allocation within their portfolio, mainly because, these companies don't pay a big dividend. And there's a reason why these companies usually, or tech companies usually don't pay huge dividends. And that's because any cash flow that they generate, they want to reinvest back into the company instead of giving it back to the investor. And that's because they see more growth that they can provide by reinvesting within the company. But that being said, we did see this gap in clients' portfolios. So we had created ZWT, which is the BMO Covered Call Technology ETF. It's an ETF that holds 30 technology companies. And I'm saying technology a bit loosely because we do hold Alphabet and Amazon, which technically is not technology as per the sectors. But if you ask anyone, Google at the end of the day is a technology company. So we do hold 30 technology names in there where we write call options on top of it. And by writing call options, we're able to generate extra income for clients. So in 2023, that yield on the product was about 5%. Compare that to the Nasdaq index, the dividend yield on that is about 40 basis points, so 0.4% versus ZWT, which is paying you about 5%. So it's extracting yield from the higher volatility of these technology companies. Second, what we do is we understand that, by writing call options, you are limiting some of the upside or that growth factor. What we do is we only write 50% of the call options. So that way you have upside on the other 50%. And I understand, I know Nasdaq has 100 companies, ARK has about 40, 50 companies. It might seem a bit concentrated, but what we do is we emphasize on quality. So the top names within this ETF is, Google, Nvidia, Apple, Amazon, and Facebook, or Meta. And if you look at these companies, right, I know they tend to be higher volatility, but given the amount of recurring cash flow that they're able to generate and the stability of these cash flows, some of these can be even listed as consumer staples. Another metric, just to put it out there, if you look at just the cash holdings or cash equivalent for some of these companies, if you look at Apple, I think about the amount of cash they hold is about 150 to 160 billion in cash. If you look at the market cap of the biggest bank in Canada, which is RBC, it's 180 billion. So they have almost the same amount of cash in their bank account than the market cap of the biggest Canadian bank, right? So, these are quality companies that we are holding in the ETF, and we are writing call options to be able to provide that extra income to investors. And the way I like to look at, not just ZWT, but the other ETFs I have mentioned, having a bit of growth exposure in your portfolio makes sense. Because even if you are, let's say, a retiree and you are going to retire in 1 year, or you're 65 years old, life expectancy for Canadians is, 20 to 25 years. So after you retire, your portfolio or investment has to last you 20 to 25 years. So it is a long time horizon. So, having a bit of growth to be able to provide that growth within the portfolio that gives you a little bit of higher beta capture makes sense. But again, it really depends on your risk appetite, your investment goals. If it's income, is it full growth? You need more diversification. And that's why, I think it's a good thing that we have different ETFs to meet different client needs and different risk profiles for each one of them.
Absolutely. I couldn't have said it better myself. I love that we talk through the different types of options, because every investor has different objectives, different needs, and that doesn't mean that you should be pigeonholed into a specific ETF or a specific type of investment. If you want to look at something like a growth sector, but you are an income-oriented investor, there's an ETF out there for you that can potentially kind of fulfill those needs. And you're being too modest about ZWT. So I know you do a lot of work on this portfolio day to day, writing a lot of options on the portfolio. And ZWT had a really fantastic 2023. I know you mentioned the Nasdaq.
Yes.
The Nasdaq performed 51%. Okay, that's I don't know if we're going to see another year like that, but for a portfolio with cover calls and options, do you have the numbers in front of you? ZWT?
Yes, yeah. So ZWT for 2023 did outperform the Nasdaq. The return was 64% for 2023, with a 5% yield. So
that's pretty incredible that you and your team are able to do that. Remember, past performance not indicative of future results. This is all for our viewers as of January,
December.
Those numbers.
The return, yes, for 2023, the 64% is as of December 31st, 2023. Perfect. But even year to date, it has done well, given some of the underlying holdings are doing well.
Just a great example of how an investor can get growth and income within a cover call strategy portfolio. Really well done. Thanks for all your hard work, on that portfolio.
Thanks.
Well, this was a great conversation. I love kicking off the year talking so optimistically about an exciting sector like tech, and thanks for talking us through all the different angles an investor can get access to it using an ETF. It was really good to have you back on the channel.
No, thanks for having me. It's always a pleasure.
And thanks to our audience for tuning in. Remember, we're here every Friday, but you can always get us on demand on our YouTube channel, and check out etfmarketinsights.com for all our ETF resources. And we will see you back here next week.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.